Hello, everyone. Thank you very much for joining us today. My name is Freddie Maverevedze. I'm a tax manager at Zeifmans, a mid-sized accounting firm based here in Toronto, Canada, and a member of our real estate team. For the purpose of today, I'll be your moderator for a live panel. And for those of you who are watching us from our live streams, Twitter, Facebook, and YouTube, thank you for joining us on our very first installment of a Part 3 fireside series, Remodeling Your Real Estate Business Financial Edition. Before we start, I would like to, or before we introduce our guests, have some few housekeeping for our audience. Please feel free to drop in your questions in the comment section or on whatever platform that you're using to watch us. We'll try and answer as many questions as we can live. And if you're unable to respond to your questions now, I will try and follow up with you later. We'll be monitoring our Twitter feed, so feel free to submit your question to us on Twitter. And also don't forget to tag at Zeifmans LLP on your tweet. So without wasting much time, I would like to introduce to you to our panel, starting off with David Bell. So David, can you tell us a little bit about who you are and what do you do?
Thanks, Freddie. My name is David Bell. I'm a senior director and commercial mortgage broker at Canada ICI Capital here in downtown Toronto. I specialize in financing apartment buildings and industrial properties in the Toronto and Montreal markets. And I work with a wide variety of clients ranging from developers to family offices, private equity funds, and institutions.
Thank you, David. We also lucky to have Jona Lemmonds. Jona, can you also tell us a little bit about yourself?
Yes, hi everyone. Good morning here in California right now. And basically, I would say I am founding partner of Asthree Wealth Group, but more importantly, founder and CEO of Launcher Wealth, which is actually our brand. But we basically promote the advocacy for financial and investing literacy. Our company, our new venture company, is actually focusing on real estate syndication. We work with private equity, we work with LP investors, but also now we're expanding where we're focusing as well on investment capital strategy, wealth management, hedge fund, and our financial services side of that is really to, hopefully we can expand in the next couple of years to Canada. So thank you, I'm glad to be here.
Thank you, Jona. We also have David Posner, who's also worked with me here at Zeifmans. So David, can you please tell us a little bit about who you are and what you do here at Zeifmans?
Sure, thanks. Freddie, good morning. David Posner, partner here, Zeifmans. I've been here for a while. I've been here for about 14 years. I focus really on tax planning and accounting and consulting, specific focus on the real estate, and pretty much, we're here for everything, accounting, tax, consulting needs, and yeah, it's pretty much what I do.
Okay, thank you, David. We also have Justin Walton. So Justin, can you also tell us a little bit about yourself and what you do?
Sure, thanks, Freddie. So Justin Walton, Managing Director with KingSet Capital. KingSet's a private equity real estate investment business which creates and co-invests in real estate investment solutions across Canada. Founded in 2002, KingSet raised about $12.5 billion of equity for growth, income, urban, mortgage, and affordable housing strategies. I think as of today, we own interest in about $19.1 billion of portfolio assets. I myself focus on the mortgage investment platform. It's about $3.5 billion across Canada, and we look to finance developers and property developers through various asset classes. That's basically it.
Okay, thank you. Yes, we do have three Davids today. We also have a David Duck. Can you also tell us a little bit about yourself?
Sure. Thank you, Freddie. And I appreciate the opportunity to be joining this great panel. So I'm a commercial real estate advisor and sales representative with Marcus and Millichap. Marcus and Millichap's the North American-wide investment sales brokerage. I myself specialize in Midtown Toronto, mixed-use urban retail investment assets, assisting clients everything from owner-occupiers looking to make their first real estate acquisition through to repositioning portfolios and larger properties within the $2 to $10 million asset class range.
Okay, thank you. Last but not least, we have Daniel Maranovic. Can you also please tell our audience a little bit about yourself and what you do?
Sure. Well, first and foremost, my name is it's not David, it's Daniel, and second, I'm the CEO and managing partner of a new private equity company in the real estate industry called Forcegate. We're just a little bit over 100 days old right now. And we're focused in on core plus properties, redevelopments, primarily in Southern Ontario. Prior to that, I was the chief development officer of a company called Dream Unlimited, a sizable public company focused in on the asset management and development space, where I've covered, and throughout my 20-year career, I've covered a lot of development activity, real kind of mixed bag of development investment activity right across the country, including master plan communities, industrial buildings, condos. I've pretty much touched a little bit of everything within all municipalities right across the country. So thanks for having me today. Look forward to the conversation with this great group.
Thank you, Daniel. I've been used to saying David, and I forgot to say Daniel.
Just call me David. No, I think you just run with it. Just call us all David. I think it'd make it easier for everyone.
That's true. Okay, thank you so much for that. So we have prepared some questions for you today, and of which I believe our listeners are very interested to hear what your insight is on these questions. Starting off with Justin Walton. As the name of our event is Remodeling Your Real Estate Business in Terms of Financing, what is your number one piece of advice or future prediction on how companies can remodel their real estate business? And also, what is your number one tip to stand out when applying for financing?
Sure. Well, I think number one is, have a plan. There's been a lot of volatility over the last 12 to 18 months. On the development side, there's been supply chain issues. We're in an escalating cost environment. Obviously, there's been tenant rollover and uncertainty in NOI. So, I think a lot of our clients have taken this as an opportunity to reposition some of their assets, to maybe deploy a CapEx program, given that you now have accessibility to spaces that were otherwise occupied through tenants. And I think, with interest rates being historically low, it's been, a great value add opportunity where, like I said, you take what the market gives you. So, I just think, being able to adapt. And the key thing that we've heard from our clients is it's volatility, not impairment. And I think, our core thesis in real estate, notwithstanding the challenges the last 12 to 18 months, we are still a big believer in the, core office market. And we think that, people want to congregate together. That's where, creativity happens. And that's one of the beliefs of KingSett. So I just think, repositioning some assets, looking for CapEx programs in the current environment, given historically low borrowing costs, has been a strategy that we've seen our borrowers, employ over the last 12 to 18 months.
Okay, thank you. David Bell, same question. What's your number one piece of advice that you'd give to your clients?
Yeah, for my clients and any borrower out there that's looking to access the mortgage market for financing on their property, number one piece of advice, and it's super simple, is like Justin said, have a plan, but number two, be organized. When you're working with a variety of different lenders, they're usually juggling 24 deals at one time for a variety of borrowers and different levels of sophistication. So one way to really stand out to a lender if you're making a new relationship or you're continuing one is have all your ducks in a row when you want to go in for financing. So, know what kind of loan amount you're looking for, know what structure, know what guarantees you're going to have put in place. And when the lender asks you for information, have third-party reports, have your org chart, have a portfolio analysis, have everything dialed in. So when the lender asks you, you can provide it immediately, and they can put you to the top of the pile on their list versus other guys or girls that they're waiting on. So just be organized and be super diligent. And I think that you'll be surprised about how far your relationship will go with that lender versus kind of just being all over the place.
Thank you, David. And Daniel, same question.
Yeah, I'd say that. I mean, we're just touching on what David and Justin said. That they're talking about adapting to the market, having a plan, being well organized. I think that kind of dovetails with a lot of stuff that advice that I would give. I mean, from my perspective, I mean, I would say just be very honest in terms of what it is that you have in terms of a development plan. So I'd expect that the range of people tuning in, we probably have anyone from smaller hobbyist real estate investors to people who probably have some more significant files, as David mentioned. And I'd say that if you're lucky enough to to get a piece of property that's under contract, I mean the immediate is to try to do everything that yourself. And the whole bit, I'd say that don't be if it's something that's a little bit bigger than you're able to take on, look for sophisticated partners that are out there, because they can be of a lot of help to you. I mean, right now, we've seen incredible cost escalations that have taken place, particularly in lumber. We've seen it on the condo side with facades and M&E and so on and so forth. So there's a lot where I see a lot of things that and a lot of opportunities that generally cross my desk. So I think having the honesty, recognizing the fact that your lender is your partner. I mean, and wants to do work with you, but you got to be kind of true to the property and true to what your ambitions are. And there's an old saying that my parents used to tell me, say, when you go to bed, you got to cover yourself with enough blanket that you got. So try not to overextend yourself, and make sure that that you've got the ability to execute and not put yourself into jeopardy.
Thank you for that. And David Gash, what's your number one piece of advice or future prediction on how companies can remodel their real estate business? And also, if you have do you have any tips on how they can stand up when applying for refinancing?
Sure. So to that extent, definitely to echo the sentiment shared here is a high degree of preparation, especially over the last year and a half. There's really a lot higher level of scrutiny added, particularly in income properties. To the extent of there's so much fluctuation and volatility in the income, you're really going to have to defend or prove that they're not just zombie tenants collecting government subsidies at this stage. And then further with that, give yourself a lot of slack, both on the timelines you need, as well as don't be surprised in this environment. This time last year, people were shocked by having loan-to-value ratios really increasing beyond what they were expecting. I expect that to obviously be, returning back to normal as the gears of the economy start resuming. But to that extent, be prepared for not to keep your margins too tight while we're still softly recovering.
Thank you. And Jona, any advice for our audience and our listeners out there?
I would say, everyone's really shared really good perspective and insight there. I'd be coming in from to that question. I would say if you're doing a smaller acquisition and you want to stand out, I would absolutely say tactic wise and strategy wise, get all of your documents in place. Write up your executive summary based on that project, and make sure your credit still, is pretty much polished up, even though it's going to be a non-recourse, loan program. And you've kind of pre-established maybe some of your assets, and of course, they look at your financial capacity and capability to really take on that acquisition. So if you're doing a smaller acquisition, let's just say 8-unit multifamily, or you're going into a partnership, absolutely would recommend have a really strong key principal or partner that's going to come in with you, where there's some track record. And that's how you can completely stand out and not be in the bottom of the pile. So that would be my best take on that. So thanks for asking.
Okay. And David Posner, same question. Any advice for our listeners out there?
Yeah, something I see a lot is what people often don't realize is your lender, your broker, your accountant, your lawyer, they're your friends, they're your partners. People are often very hesitant to give information. They think that, we're a CRA or, something like that. That's not how it is. Usually we're trying to help you get to that goal. And if just give the information, and if it's something that's not good, we can help you fix it or deal with it, but don't hold things back, because then things just drag and things just don't get fixed. So choose the people that you're working with are your partners. That's very, very key. Number one. Number two, something we find on that line is when you're talking about being prepared, very often you can be a person, you have company A, B, C, and D, and you want to purchase a property, but you don't know if it's going to be company A or B, or it's going to be a partnership or a corporation or an individual. And it's people don't realize that even if you own all of the companies, or you're the controlling partner, every company is its own thing, right? And you need to decide beforehand which company you want to use. Don't just come in and say, well, I'm buying the property. Which entity that you own is buying the property? Because things and needs change based on that. So don't think of yourself as you and everything you own, but each company is its own, or each partnership, is its own, and have that kind of nailed down before you apply, because it's much easier to change things before things happen. And once all the papers are signed or things change and you want to switch the owner, and then there's land transfer tax, or there's so many things that can happen. So it's important to know what the entity you have beforehand when you're making the purchase.
Just following up on David Posner's point about lenders being your partners. There's a great line that was once told to me that if you look at a really busy street in New York City and there's office buildings on both sides, those are the institutions that are your partners, right? So those are the banks, those are the King Sets, those are the MCAPs, the First Nationals of the world. And the taxi cabs, the yellow cabs that you see everywhere on that street are deals, right? And every day there's going to be hundreds and hundreds of deals and taxi cabs that go by. But your partners, those office buildings, they're never going anywhere. So thinking of those lenders like your partners, because there's always going to be another deal that's going to come by, another cab's going to come where you could get in it. So treat your partners with respect, and don't push yourself to get one deal done, because there's always going to be another one, but those buildings are never going to go anywhere.
And then I'll also add, that's a great point, where transparency up front, where a lot of times when we do see an opportunity, there's going to be hair on every deal we look at. And I think we, as a lender, we look at, the opportunity to help solve a problem with a client. And to David's point, like transparency up front to say, hey, here's why we like the opportunity. Here are the challenges. We enjoy working with clients to find creative solutions in order to get deals done. And I think, to your point, acknowledging where there's an issue up front rather than finding it out on the back end of a deal where it wasn't brought to your attention will have a huge impact on our ability to want to work with the borrower going forward. So transparency is key. Relationships, I agree with everything everyone's saying, but just being upfront and disclosing all the information is imperative.
Don't be scared. That's pretty much what it is. Just be free, let it go, because just open up, because it'll only help you up front. Don't be embarrassed. We're all here to help. We're here to fix it, to make things work. That's a key point, which we see people don't necessarily pick up on.
And you get paid. You get paid to help them.
Yeah, exactly. Yeah.
And I was going to add on too, as that question is put on here, is that as you're scaling your real estate business, I believe you're going to be building your team of experts and professionals that you can definitely rely on. And to that point, before it's too late. So due diligence. So absolutely, have a strong due diligence process as well for the property, so you can actually deliver this executive summary that sets you apart from everyone else. So I just wanted to add that on, that I think, everyone becomes your partner as long as you also are able to how do you say, be, likable with them, right? Like, you don't want to work with somebody you don't like in that sense. So I think it's being able to scale that, you definitely have to consider building a team of those that you can rely on, and they can rely on you as well. So. Yeah,
I'll just, I'll round it up, because I think there are great points in the spirit of partnership, and in the spirit of the million taxi cabs that are coming through down the avenue. The assistance, the knowledge base is there in terms of what the construction costs are, what land inputs are, what lease rates are, what sales prices are, what development charges are, what timing to completion is, how can you reposition an asset. I mean, all that stuff is at your disposal. And I think, as you're organized and as you're being transparent, and the more transparent that you are, I think that your partner in that is going to be more transparent with you to guide you through the process and help you get to the finish line.
Thank you. Jona, a question for you. Your personal mission is to make wealth creation accessible to all walks of life. Can you please expand on this, and what are you doing to rethink the future of financing in real estate?
Gosh, that's a really loaded question. I'll try to answer it as personalized as possible. Making wealth creation, I think, for so many years, we know this with history, so I'm not going to go that route. We know that it's quite exclusive. And so, a lot of us growing up, we don't understand financial literacy. We didn't, get exposed to investing until we literally stepped out of the real world. And I speak from my own personal experience. So it was really rooted on that story. And so the mission is really close to me. So we want to make sure, as Asthree Wealth Group, we are embodying those core values and where we come from, because I think making wealth creation accessible, meaning, we're providing financial and investing literacy to our clients and to those that we want to work with, because they're not going to know your niche. So sometimes you have to build that relationship and really open up those opportunities and say, hey, maybe there's a way we can work together. So never eliminating or underestimating the power of those relationships, but also, on a conscious content to be able to deliver educational opportunities through our pathway, through our company. But more importantly, the inclusion. We're moving to this future. So, the topic theme is remodeling your real estate business. So absolutely, I'm always remodeling. I never, would ever think that we're comfortable and this is it. I think that is one way to really kind of get the message out, if I may say that, the inclusion and creating that equity for all to really begin somehow understanding investing, because that opportunity is more importantly needed now more than ever because of the pandemic, COVID. And I think it's going to be the next wave where we can bring everybody from all walks of life that diverse experience to really understand that real estate is a good avenue for building wealth. So I want to open that up as part of our true mission, because that's where I started. I started my business with $200 in my pocket and a whole lot of sweat equity. And so I am a living example of that. I don't come from wealth, but I certainly come from, a lot of life experience that I've put in for 20 years plus. So thanks for asking that.
Thank you, Jona. And also speaking about the pandemic, Justin, how are you advising your clients about applying for financing after going through a down year due to the pandemic?
Again, it's more just being thoughtful in what you're looking to do. For example, on the development side, we're making sure, and I think Daniel alluded to this about, costs are substantially different than 6 months ago. And making sure that, if you're going to build, a condo building or a mid-rise or whatnot, to get your tendering done early, understand some of the challenges in supply chain issues today. There are some trade capacity issues. So just having a plan up front, locking in as much of your costs. I think that for us, we see a lot of deals and on paper, everything looks viable, but it all comes down to having a team in place that can execute. And I think that's been, one of the things that we focus most of our due diligence on is the execution risk, and being thoughtful as you scale up. So if you're a custom home builder, let's not go build a 25-story condo as your second project. Guys are doing infill towns or whatnot. So just being thoughtful in that approach, working with, great partners in terms of architects, consultants, hiring a great sales and marketing team that are going to maximize your revenue. And one of the things we're seeing from clients now is, traditionally, you'd want to max out pre-sales on a development project. But today we're seeing, guys holding back 25-30% as an offset to some cost escalations, which, can help on your margin if there is, some changes in the marketplace. So I think, just like I said, being aware of all the volatility in the market today, and just making sure that, going back to having a plan in place, having a team that can execute, and having the wherewithal to deliver on time, on budget.
Mm-hmm. Thank you, Justin. David Bell, same question. How are you advising your clients about financing after going through, this downturn due to COVID?
Yeah. So back to the original point with the buildings in New York, it really during the pandemic came down to relationships. Once everything settled out, after people realized there was going to be lockdowns, there was a huge bifurcation in the lending market. So if you had lenders that were interested in office, retail, industrial, and apartments, most lenders shifted allocation quite heavily towards industrial and apartments and took it away from retail and office. So if you owned a retail and office building during the pandemic, it was more tricky to get deals done. And the deals that were getting done at favorable terms were from lenders working with people that they've liked and they've had a good history with. And on the flip side, if you have an industrial apartment building during the pandemic, you've done incredibly well. But you should also still be open to building new relationships, because if there were 10 lenders that were going to finance your 75,000 square foot, Class A building in North York, now there's 25, right? And because people shifted more money into those food groups. So be open to making new relationships and always maintain good relationships with your existing lenders and partners.
Thank you. This question is for all of you. Starting off with Daniel. In your opinion, how has the industry changed due to COVID-19?
Yeah, sure. So I don't know if anybody even remembers the industry, in March of 2020, but it was such an incredible, and I'm curious to others' perspective, but it was such an incredibly tight market in so many regards. So you had industrial vacancy was zero. You had multifamily vacancy was zero. The office market, vacancy was effectively zero. Everybody was trying to get their application approved for condo sales. Consultants were completely overwhelmed with the amount of work. There wasn't enough trade capacity in order to actually physically construct the stuff that needed to get done. Then you have this, this seismic shift that ended up happening with COVID and the whole bit. It kind of opened up a little bit of slack, I would say, in the system initially. The industrial market basically took like a 4-week pause, and then with demand from people like Amazon and others, they just kind of went right back at it, and all the industrial developers started to spec industrial buildings again and the whole bit. But I would say, like, if you're asking, how did the industry shift in terms of the way that people work? Look, one, I mean, I think that obviously the work from home element is tremendous, because you're not in a cab racing from your architect to your planner to your banker to so on and so forth. I mean, it's you're one meeting after another. So the volume and pace to be able to kind of get stuff done that was an impediment prior to then has now definitely picked up. I'd say that there's a huge discipline that's taken place as a result of it. And then likewise, I'd say that if you're actually on the ground, I mean, people who are out building the projects, I mean, they had to adapt to COVID on site. So I mean, that was an interesting thing from like a scheduling perspective. I mean, if you've got trades that are coming in and one after another, now all of a sudden you can have these this trade in, then you got this trade and then this trade. So there's an efficiency that started to occur. But mind you, on the macro level, I think it's probably exacerbated. The costing side of things, which is a massive concern right now, and people have to, as Justin alluded to previously, it's a continual adaptation. You got to have a finger on the pulse in terms of what's happening to municipalities, what's happening on the ground, how are your costs evolving, and the whole bit. So I think that that has been changing at a very rapid pace, and I think that the developers who are bigger have been adapting more quickly as a result of some of the fundamental shifts in terms of the way that they operate on the ground. So I'd say that, again, talking about depending on the audience, I think that awareness really needs to kind of people need to be mindful of having that awareness when they're entering into a project of ambition.
Thank you. And so, David, Josh, same question. What's your opinion on the change in the industry right now?
Sure. So at least where things fundamentally have shifted, which will be here to stay, I would say start in the diversity of business and operations between the flexibility. We saw a very Darwinian shift of businesses that weren't able to cope, really struggling, whereas other businesses embracing digital media as well as virtual working really thriving. And so obviously we know that the effects of COVID disproportionately benefited some and disproportionately punished others to an extreme extent. And so one thing that I've been keeping a close eye on is to what types of businesses are acting, have that savviness in terms of what they're adopting. While some restaurants are struggling, other restaurants, such as adopting ghost kitchens and virtual sales, have been thriving, or using the outdoor scene to reinvent themselves by building patios. One thing, the nature of office working, agreed with, we can all say, has fundamentally shifted for continuously in terms of the flexibility of that. And I think that we'll be thinking post-COVID, be a lot more thoughtful as to how we're using the spaces for our businesses, whether it's having more flexibility for, the shifting to 3 days from home, 2 days in the office, vice versa, whatever someone allocates for themselves, or commercially, what am I allocating for retail presence versus omni-channel warehousing.
Okay, thank you, David. As I mentioned before to all our audiences, if you have any question for any one of our panelists, please feel free to drop all your questions in our comment section, and we'll try and answer as many of your questions as we can. Right now, I think we do have a question from our audience, and this is directed to all of our panelists. So if you have something to say and you want to jump in, just go ahead. So one of our listeners wants to know, what is the best way to find and buy a first investment property that is cash flow positive for a young professional when real estate seems to be out of budget? Any takers?
Well, to simplify that, I would say when I was just starting out in this business and career, that was usually the common question, especially amongst people that I knew just getting started. So, that's a very complex question because it depends where you want to focus as far as the market and the niche. Are you trying to do, a BR method, which is you're going to buy a property and pretty much renovate it and turn it into rental? So it's really a strategy play on how you want to start acquiring those assets and turn it into your investing opportunity. So you have to choose your market and your niche and what type of asset class. And what is your strategy? I mean, if your budget is, XYZ, then absolutely create a business plan that would match the budget. And then start your research, build those relationships that could feed you those potential property deal flows, as I call it. So that would be my take on that.
And anyone else?
Yeah, if I may, as a investment specialist focusing on helping clients start or maintain their portfolios, that first and foremost, the reality of at least the Toronto market is that many people are priced out from the onset. So depending on your capacity and the funds you have to start with, either choosing a softer market. I mean, if you have the benefit of having access to the wider GTA region, you might be able to find, more accessible opportunities in Hamilton or Guelph at more affordable rates than you would in Toronto with a better yield. But by the same token, or if you are really focused and oriented on premium A-class opportunities, think a little bit outside the box. Maybe consider looking at local funds. There's often a great, limited partnerships that are not, well known. And looking into your research as to what type of REITs or public equity providers may have new interesting opportunities that you could invest in.
Okay.
I'm gonna piggyback on what David said. David is bang on in my opinion. Right. There are record precedent investments being made right now in transit and infrastructure. Now we've had this massive shift in terms of the way that people work. Everybody knows, like, we'll go back to the office, but one thing is for sure, we know that we can all work within this type of forum. We all know that we want to spend time with our kids. We all know that we want to be there for certain things, and we want that embedded flexibility. That's opened up between the infrastructure investment, this mindset shift, and the fact that immigration is at levels we haven't seen it since World War I. That's just kind of wide open. It's going to create a wealth of opportunity in a lot of markets across Southern Ontario. David mentioned a few, but I think that if you're starting out, you can look at places out further afield, and I think he's also bang on in terms of take a look at the REITs. There's a ton of great publicly traded REITs that are out there. There are a ton of private REITs. Come up with your investment thesis in terms of where you want to put your next dollar. There's a lot of mortgage funds that are out there as well, and that gives you the opportunity, even on a tax efficient basis, to get in and to get out, and you don't have to deal with, and you can bite off as much as you can chew, and it's not as a liquid as real estate is at the same time, but it gives you the same type of exposure, which I think is highly beneficial.
May I chime in on that as well? I think, when I was, sharing my insight is, I think really as a new investor going into the market, absolutely predetermined, do you want to be an active investor or a passive investor? I represent Vancouver and of course Los Angeles, and you will be priced out. There's no such thing as fix and flip unless you have a partner with a ton of money and experience that go along with that, and you're willing to take those risks. So predetermine, are you an active investor or you want to passively invest, just to kind of get that capital going. And absolutely, the US has become a hot spot to passively invest. So again, it's determining what strategy you want to do, your risk tolerance, and absolutely the market niche that you want to get into. So just wanted to add that on in case the person that asked wasn't sure yet whether they're an active or passive. So
okay. So Justin, the interest rate are historically at the low levels right now. Do you think the rates will stay this low? And also, what do you tell clients who are concerned that the interest rates will be much higher than they are now when they finance period of their mortgage, when it's time to finance their mortgage?
Sure. So listen, I kind of read the same articles in terms of Bank of Canada and predictions on rates. Like, I think the economy's been a little more resilient, through COVID, specifically in Canada. I know that, global growth is, I think, projected at around 7% by the end of the year. And I think that's going to, look at rates slowly coming up in 2022, whether that's the first half or the second half. I think it's to be determined. But I think it's inevitable that, within the next 24 months, you are going to see interest rates creep up. And, as inflation stabilizes at, 2%, which I think is the target goal from the Bank of Canada, like it's inevitable that's going to happen. In terms of, concerns I have, I think I look at, and this is more a question maybe for David Bell, but when you see, multifamily, 5-year term deals under 2% right now at 40-year amortizations, these are CMHC insured, and they're stretching it to a 110 or 120 debt service. I always wonder that in 5 years' time, if the pace of rents don't keep up with interest rates, like what's going to happen in 5 years when all these guys go to renew and now they're flat or underwater on debt service, right? And obviously, I think a lot of these guys think there's going to be a correlation with rental increases along with interest rates, but I think it's always a concern. For myself, paying down debt or increasing the AM to maybe more conventional 25 or 30 is not a bad thing. Notwithstanding, you can take this opportunity to, again, leverage the fact that rates are so low, pull out some cash, reinvest in the property, hope that's going to be a value creation. But, I think you got to be strategic and thoughtful and understand that, rates are low now. They will not always be low, and just make sure that you have sufficient liquidity in the event that, there is an increase and deal with that. So, I think, a lot of people just think that, like I said, rates are going to be low for long, and I know the Bank of Canada has kind of gone back and forth on that, but I think, for 2022, at least second half of the year, you're going to see them creep up, and you just have to have a plan, make sure you have adequate liquidity, and plan accordingly.
Okay, and also David Bell, a question for you. What is your prediction of the future of commercial real estate development, specifically about how will companies access financing?
I can't speak so much to the future of development as that's not really my expertise, but in terms of financing, I think that over the next 3 to 5 years, there's going to be a lot of new lenders that are going to pop up in Canada. If you look at pension funds and their allocations towards fixed income, it's very hard to earn money on a bond or a Government of Canada bond. And it's very attractive to get into mortgages, whether that be investing alongside Justin or other companies like ACM. I think that these big institutions and pension funds are going to want to put more money into mortgages. And when you have to deploy that much capital, I think there's going to be a lot of new products and new funds that are going to come out of that are going to change the market a bit. I think that 5-year, 10-year IO is something that's seen down in the United States like regularly. No one amortizes much in the US. And I think that you're going to see new lending products come out in Canada probably in the next 2 to 3 years on the commercial side that people haven't been used to before.
And one of the things I'll add to that is, one of the things we see today is there's a big delta in how certain institutions are pricing risk. And there's some opportunities where, I'm competing against another lender on, this could be a piece of land or a development project or a repositioning of an industrial. And, I think I'm pricing it to market, and there's a 200 basis point delta in my pricing relative to the competitor because they're sitting on a lot of capital and they want to deploy right now. So I think, like I said, as much as I think maybe risk is underpriced in the market today, I think it's advantageous for borrowers that there's a lot of liquidity out there. And, if you're looking at refinancing or repositioning, there's a lot of options as David noted currently, and I'm sure they're going to continue in the next, few years.
Interesting. Yeah. So this question is for all of our panelists. Maybe we can start off with Jona. What new opportunities regarding financing are available due to COVID?
I would say, I'm not an expert on everything. So, my take on this is how I've observed for the past year that we're here, during pandemic. I would say capital is cheap right now. A lot of movement, specifically. So I know creatively, funding your project or your, with creative, building those relationships with key principals, operators. To multifamily, I say, the creative side of it is really you figuring out what niche you're trying to build into and those partnerships, because capital is available. And that capital, micro and macro, right now there's a lot of movement. We mentioned about migration. There's also migration of wealth. So a lot of people want to private lend, entities want to private lend. Being here in the US, Freddie, Fannie, interest rate is at 2.5, 2.6. So if you're building a team, you're building your business plan to get into, creative financing for your projects, absolutely get out there, expose what you're doing, create those partnerships that make sense to you, of course, and take advantage of that at this point.
Daniel, do you see any new opportunities regarding financing out there?
Yeah, I'll piggyback on what others have been saying. When we talk about financing, I think 9 out of 10 people, your head just kind of goes right to the banks, right? So I think as Jona mentioned, you've got your traditional Sched A lenders, you've got your credit unions, you've got the BDC, you've got CMHC, you've got a tremendous amount of you have a lot of alternative lenders that are there as well. And coming back to the genesis of the conversation, if you're just starting out and let's say want to do a little property or whatever, you can start to build your I can't remember who said it, but you can just start to kind of build your initial first steps through those channels accordingly. And as you kind of get sizable, you you can start to kind of spread out, but all of them have different parameters. There's a lot of capital that's out there, and right now with the amount of stimulus that's in the system, everybody's chasing yield. So, also kind of talking about what we've been talking about the lenders being your partner, they are motivated to put the money out and to help you by making sure that you have an honest and a good development plan, and speaking to execution that is going to go and get fulfilled. I can definitely see the way that the market is going in terms of affordability and the whole bit. I think David nailed it. We do not have David Bell, I should say, of the Davids. David Bell nailed it in terms of interest only loans, non-amortizing loans, which are not typical here in the Canadian space. But given where pricing is inevitably going and the like, it's going to be something that we're going to see more and more of here. If you want to choose to own real estate, CMHC has been wonderful. Over the last number of years, they've been very entrepreneurial and business-minded focused, and they've been introduced a ton of programs that have helped developers, primarily the RCFI financing, which has helped, if you have affordability provisions, if you're doing things that are good for the environment and so on and so forth, then the coffers will be open, and you'll be able to borrow, and you'll be able to borrow on a very competitive basis, and your returns will work. And again, it doesn't have to be in downtown Toronto. It can be in market whatever in Southern Ontario. So I think people should be abreast of that accordingly.
Okay, David Posner, do you see any new opportunities regarding financing out there?
To tell you the truth, yeah, because what people don't realize is even though COVID, people always focus on the bad, the companies are going under, they can't make, rent or, payroll. That's all happening. But there's a lot of companies out there also that was focused on a certain type of work, and during COVID, it exploded, right? And a lot of companies that before that you don't really hear about, all these companies that are making now a lot of money. Their business model that they had before COVID, for COVID it works, perfectly. All of these companies like online. So there's a lot of companies that you wouldn't have thought before are players, and they're players now, and they're looking to invest. They might even want to lend. So there's a lot of companies out there that have capital. They're not really sure what they want to do with it. A lot of them are thinking about getting into lending, and they never thought of that before, just because they didn't really have the money. But we have some clients, and they were just these line companies, and they've exploded. They're sitting on millions of dollars, and one of the things that they're thinking about doing them is lending. So there are companies that just never thought about lending that are now might be getting into the game, which adds the pool of overall capital to somebody looking for financing.
David, got anything that you see out there regarding new opportunities?
Sure. Well, to that extent, it's interesting to call it a new opportunity, but considering it's the current status of what we have right now, we're definitely looking at a phenomenal environment of which you can refinance, because now we do have our footing again in being able to make these forward-looking decisions. Lenders are back at the table. This time last year, if you didn't have a direct connection or a very strong relationship you could leverage, it was very difficult. Now I see the general sentiment has been very pervasive that there's a lot of cash out there that's looking to be deployed. And I think particularly for notable windows of opportunity between now and the fall, in October, OFSI, the financial services regulator, will be increasing the domestic stability buffer, which is a small indicator of they'll be increasing it from 1% back to its original state of 2.5%, which takes a little liquidity off the table, and I think will also be a sign of more business as usual, green-lighting interest rates in Bank of Canada to start, making their slow movement towards increasing interest rates. So I see, at least for the remainder of the year, it is really an ideal time to take advantage of the depressed market, at least we have for rock bottom interest rates that really at a historical low.
Thank you for that. And Daniel, You recently launched the Forestscape Financial Corp. What inspired you to create and launch your own private equity investment development and asset management company? And what sets you apart from your competitors?
Sure. Thank you for asking. Look, I think we launched it because we recognized an opportunity in the market. Just as this panel has been guiding people out there to evolve their thinking. I mean, my thinking has evolved over the last 20 years, and with respect to the pandemic, I think that there's going to be a big whipsaw bounce back. I think in Canada, I think that Canada is it's a wonderful place to live. I mean, we're all sons and daughters of immigrants, and a very welcoming and a great place to live. Right now, our borders are closed. People are literally pounding to get back in. So again, putting your mindset back into March of 2020, there will be a continued momentum that's out there. Our group is in the private equity space, so I mean that means different things to different people. We look for assets that we want to invest in, and we have a flexible and an open mandate. So that right now we're looking at we've just recently transacted on our first multifamily apartment building. We're looking to build up that portfolio accordingly. We're looking at some others, some industrial plays, retail, land, and the whole bit. Again, building on the conversation here in markets that we feel are underrepresented primarily throughout Southern Ontario. So there's going to be a wealth of opportunity that we see primarily with work from home continuing the way that it is, and we're kind of competing in the space in between the big institutions and above the people that are just the smaller investors that are out there. So we're kind of acquisition sizes of 20 to 30 million, I'd say, and above right now. So that's kind of that's the space, and above all, I love what I do, and I want to continue loving what I do, and being part of this great industry.
Okay, it's always good to do what you love. Time flies when you're having fun. But just before we close, I would like our guests to share their closing thoughts and advice. Starting off with David Bell.
Be organized, be truthful, and treat people with respect and build good partnerships. It's honestly as simple as that. I mean, finding deals and money is kind of table stakes, I think. But if you can do the four things that I just said before, I think you'll have a very long career and people will enjoy working with you.
David Posner.
Failure breeds success, and if you're applying for a loan or if you're looking at a certain property and you've thought that you've done everything and you have great partners, and let's just say it doesn't work out, don't quit. You'll kind of learn from where you went wrong, or it just wasn't the right time. But keep on going, just like with anything, just keep on going. So just because you fail once or even fail twice, it's just use it as a learning opportunity. Don't give up. That's my main, I would say. And
Justin?
Yeah, very, very similar. I think, transparency in relationships, being an open book with your lenders. We're here to help. We're consultants. I think someone already noted, we have a pretty good Rolodex of, transactions and can kind of give you our insight and try and add value. So I think keep the lines of communication open, and, that's the best advice I can offer.
And Jona?
I would approach it from the investing and as an investor. I would say, look at the bigger picture, have a vision, create a plan, absolutely work on building alignment with potential partners and your relationships. And I think overall, just to kind of take it back on everybody here, mindset is everything. I think when you create that vibrancy, you will find that alignment as an investor and in your investing endeavors. So trust yourself, trust the process. You're putting yourself out there, whether you're starting small or you're scaling as a business, and also your real estate portfolio. So trust yourself as long as you have that plan and you have a big vision. So don't be limited. Thank you for that.
Thank you. And Daniel?
Yeah, what Jona said. No, I would say definitely have think big, have a real vision in terms of what is it you're going to do. Ask a ton of questions. Ask a ton of questions. Validate out everything that it is that you're doing. Don't take no for an answer. Be passionate about the work that you're doing. I think Jona also mentioned that there's a big difference between an active investor and a passive investor. And real estate, if you're in the asset management or development space, in the investment space, you're like, I'm looking at sizable acquisitions, and I'm also looking at low flow toilets, like within minutes of one another. It is a granular, gritty kind of business, and so recognize what space they want to be in. But it's a great business, and be passionate, love what you do at the end of the day.
And David, the third.
Sure. So with that, echoing some of the great opinions I've had here, definitely just as much as your diligence and research, your relationships also can be your biggest asset. As to when you're in a pinch, you shouldn't be speaking to your lender or your lawyer for the first time. You should already have a long-standing rapport, and that really really helps carry you through the distance when you are stuck in a situation where you do need to that extra to call in a favor per se. And then beyond that, just because things are clearing up right now, let's not let our guard down in terms of our preparations and the way we're approaching our deals, as we are in an industry that, market value is based on historical performance. And so it's still, just because things are very sunny right now, we're still going to have to take some time for the trailing yields to restabilize before we're really looking forward without any repercussions of the past year we've gone through.
Thank you. So thank you, everyone. So we have reached the end of today's live section. Thank you to all our guests for joining us today. And if you have any question for anyone, please contact us directly at info@zeifmans.ca. We will make sure we'll connect you with the appropriate party. And thank you so much for joining us today. Thank you.
Thank you so much.
It's been a pleasure.
Thank you, Zeifmans. Thank you, everyone.
Thank you for your time.
Thank you all.
Thank you.
Good to see you.